Have you ever wondered why I bang on so much about figuring out non-guarantor levels on day one of any leverage finance deal? It's structural subordination, folks, and we're going to go through an example of how to do that using Ocado's deal from this week. My name, for those of you who don't know me, is Sabrina Fox. I am founder of Fox Legal Training, and I use this channel, the Primary Market Education Series, which is also a course on our Fox Legal Training online covenant platform, to give you some practical tools, tips, and guidelines on how to analyze deals quickly and efficiently, focusing on the most important information rather than trying to get through everything in the length of time that you have to look at a primary market deal. You've been doing this for a while, I'm sure you know that's not really possible. So how do I focus on what really matters? And that's what this series is all about. So I'm going to share my screen and pull up the Ocado deal. Now, I'm not picking on Ocado. When I pick deals for this series, I do it because it's a clear example of for something, or it's a provision that I haven't seen in a while, or it's something that in the context of that deal is useful to explain. And for Ocado, what's interesting about the deal, first of all, it's a fairly sort of simple capital structure in the context, in the greater context of the market. But also what's great is that there is some distinction between guarantors and non-guarantors, and there are some provisions in the debt covenant to deal with that. So I can show you what they look like, and that's really why I picked this deal. So when you are starting your analysis, you always want to start with the capital structure. And I like to start at this chart here. This chart is going to give you so much valuable information about the other debt in the capital structure. If it's an LBO, the size of the equity check, whether there are unrestricted entities or joint ventures outside of the restricted group. The distinction between guarantors and non-guarantors will be indicated usually by different colors in the chart. And you'll be able to see the debt that you are buying. You can see 300 million notes offered hereby. And then the notes here, that little 3 and the little 12, etc., all of that, that refers to the footnotes here, which will also provide some really valuable information about the deal. So we're focused on the guarantor, non-guarantor split. And the note I'm going to look for that is note 6, because I can see the non-guarantor subsidiaries have this note 6. So I'm going to go down to note 6, and I've already highlighted it. So obviously did a little bit of work in advance. As of the issue date, our direct and indirect non-guarantor subsidiaries did not have any material financial debt outstanding. Great. That means on day one, your structural subordination risk is not high. But what's really important to determine is how that position can change over time. So I call this starting point A. And when we do the analysis of the debt covenant, I call that point B. We want to understand how this can change, because you're buying into this bond. You're not just buying for today. You're buying for now until the borrower refinances. So you really have to get a sense of how the picture can change down the line. So then it goes on to say our non-guarantor restricted subsidiaries represented 13.1% of EBITDA, 39.7% of net assets, and 12.5% of restricted group cash adjusted EBITDA, etc. Okay. So when I think about the guarantor non-guarantor split, when I start to think, I want to know what capacity they have to incur debt at a non-guarantor, I think that anywhere from probably like 10 to 15% of non-guarantors in the entire group outstanding. And the reason that I say that is any non-guarantors will reflect the potential for the borrower to provide a preferential place in the capital structure to a potentially a third-party lender or an existing lender. Because the nature of structural subordination is such that if there is no guarantee from that entity, so we go back up to the picture here, these entities here and here and here, they have not provided a guarantee of the notes. And what that means is there is no debt claim at that box. Now, A guarantee is a promise to pay if the borrower doesn't. It is just as valid as the borrower's obligation to pay, their promise to pay. Guarantor will step in and say, I'll pay too. So it is a debt claim. Now, if there is no debt claim at these boxes, what it means is that the only right that the bondholders have is by virtue of the equity claim of the next obligor in line. So Ocado Innovation Limited here owns these non-guarantor subsidiaries. That's an equity ownership, but there is no debt claim. So let's say hypothetically a third-party lender were to come in and loan into this box. What that means is that they now have a better claim to the assets of that non-guarantor than the note holders do, because as we all know, equity ranks below debt. So as soon as you have a debt claim at a box where there's a debt claim at a box that you don't have a debt claim at, they are going to be structurally senior to you. So that's why I go on and on about why it's so important to figure this out. And also, obviously it depends on the company. It depends on what they do, the operations, place, like all those things that as credit analysts, you will have spent a lot of time thinking about. That context does really matter. So when I'm looking at this outside of that, but just objectively based on what the language says, that's why I say anything non-guarantors representing 10 to 15% or above is something that I would make the analysis of non-guarantor debt capacity one of the things on my to-do list. Now, if non-guarantors are below 10%, it's going to be tricky for a borrower to lure in a third-party lender and say, look, here's this value. I mean, it's facts and circumstances, it depends, but that isn't really a sufficient level of value to, say to someone, here's your pocket of value here. So that's where I get that level from, that threshold from. Okay, so now that we've looked at that and I've seen these numbers, which do make me think I want to know what non-guarantor debt capacity is so I can close the circle in terms of the risk here, we're going to go down to the description of notes. And specifically, we're going to look first at the guarantor and restricted subsidiary disclosure. So I'm just going to pop to the beginning of the section so you can see where I am just for navigation purposes. We're in the description of notes. And one of the very first things that you are going to see is this disclosure on guarantees and restricted or unrestricted subsidiaries. So if we just quickly navigate back up to the summary corporate structure, I just want to remind everyone, this box here, that dashed line, that is the restricted group, as it says here. Anything outside of the restricted group, it's not restricted by the covenants, not part of the collateral package. Residual value may flow in the event of a bankruptcy, but in addition to that, they can incur whatever debt they want. They can spin it off to equity if they want. So far as the restrictions in the documents are concerned, anything outside of this box is not restricted. And that's why they call them unrestricted subsidiaries. One of these is a joint venture. It's a slightly different thing, but it's just important to explain that a little bit. So what this section is doing is it's telling us that as at 1st December 2024, the issuer and guarantors represented this level of assets. Non-guarantor restricted subsidiaries held 39.7% of net assets and 39.6% of restricted group net assets. And then issuer and restricted subsidiaries taken as a whole are 76.3%. And then the Ocado retail joint venture is 8.4%. So this is giving us some really good disclosure about the value that's in the box, the distinction between what is held by guarantors and what is held by non-guarantors, and what is outside the box. So if I were a credit analyst, I would be looking at this, I would be highlighting this, and I would use this as a basis to say, okay, that's a pretty sizable level of non-guarantor asset threshold. So I'm going to go down to the debt covenant. I'm going to do my review for non-guarantor debt capacity. And now I'm going to teach you how to do that. And we're in the certain covenant section. The debt covenant usually comes first. In this first paragraph is the fixed charge coverage ratio. This is the ratio debt basket. The ratio debt basket in a high yield bond is always the first paragraph of the debt covenant. And indeed, in later sections, it will be referred to or cross-referred to as the first paragraph of the debt covenant. So it's just something, kind of term of art to keep in mind. And then this clause 2 is where the permitted debt baskets begin. So I'm looking for language that says the issuer will not permit any either restricted subsidiary or any guarantor. Now, if it says guarantor, that means that the basket is only available to the issuer and guarantors. If it says restricted subsidiary, like it does here in clause A, that means that non-guarantors can incur under this basket. So when I'm reviewing the debt covenant, I'm reviewing for 3 pieces of information. Okay, 1, I'm going to grab the clause number. Those of you who've watched previous episodes will know that I'm evangelist when it comes to getting the clause numbers, because cross references in these contracts are rife. It's huge. So they're never going to say the credit facilities basket. They're going to say clause A. So you should make a note. It's clause A, right? And then the amount, which here is 300 million, and then who can incur the debt. So in this case, incurrence by the issuer and any restricted subsidiary, including non-guarantors, because it doesn't limit the basket to guarantors. So now I'm going to do that same analysis for every basket where I can see a number. Now, again, this is a quick review style. The style that I'm teaching is I want you to get through this quickly. I want you to find key information quickly in the time that you have to review these deals. So I'm looking for numbers. I'm looking for dollar amounts, right? So anything that doesn't have a dollar amount in it, I'm going quickly past it. Here, clause F, right? I'm highlighting the number or the clause, clause letter here in this case. This is for capital lease obligations, and it is any restricted subsidiary. So guarantors can, or non-guarantors can incur here, and it shall not exceed the greater of 80 million and 2% of consolidated total assets. Okay, so I'm going to do that for every basket that I see which has numbers in it. Now, obviously, management advances is going to be some amount of debt, but it's not going to be a significant amount. So I pretty much skip that. This one looks important, right? That's 300 million. So it's clause P, incurrence by debt of the issuer and any restricted sub, not to exceed 300 million, where net proceeds will be used to fund capex. So that's a really important point here this raises, which is check the amount, but also what can it be used for? Because this must be used for capex. It does not allow the borrower to use it for any purpose. So that's a really important point to make a note of. Clause S, we have another number. And this doesn't even say incurrence by issuer restricted sub. So absolutely this can be used by non-guarantors. And this is set at the greater of 140 and 3.5% of consolidated total assets. Now, this is the acquired debt basket, and it's limited by the fixed charge coverage ratio, or that the fixed charge coverage ratio would not be lower. And this is also incurrence by the issuer and any restricted subsidiary. Clause T. Okay, acquired debt. And I would look at the definition of acquired debt. It doesn't happen all the time, but sometimes the amounts are in the defined term. It does happen with contribution debt, for example. Sometimes contribution debt can be 1-to-1. Sometimes it can be 2-to-1. So it's important to look at the defined term. But here it's fixed charge coverage ratio, or fixed charge coverage ratio is not worse. Okay. And we're going to keep going. Here we go, contribution debt. I'm going to look at that defined term just because I want to see how much it is. Yeah, 15 million is not really something I would make a note of. And then finally, where it's said. Okay, and this is issuer on any restricted subsidiary, and it's the greater of 140 million and 3.5% of total assets, consolidated total assets. Okay, so leaving everything else aside, if we stopped here, which I'm not suggesting that we will, but if we did, you would be looking at large structural subordination risk, because every single basket we looked at was available to non-guarantors. But there are a number of ways that borrowers can indicate whether baskets are restricted from non-guarantors or whether there's a cap. sometimes there will be language in the ratio debt basket itself, somewhere around here, which refers to non-guarantors and a cap on non-guarantors. Sometimes it's at the very end of the covenant, and that's what we see here. So it says, notwithstanding the foregoing, the aggregate principal amount of debt incurred pursuant to paragraph 1, which is the ratio debt basket, and clauses A, P, S, T, A, and Y of paragraph 2, or in respect of any permitted refinancing debt by guarantors that, restricted subsidiaries that are not guarantors shall not exceed 140 million or 3.5% of consolidated total assets. So there is your non-guarantor cap. And this is why I love that this deal came out this week, because I was able to illustrate that to you really clearly. Now, remember, it is only incorporating the ratio debt basket and A, P, S, T, A, and Y. So let's have a look at those. Okay. A is the credit facilities basket. P is the CapEx basket. S is guarantees of qualified joint ventures. TA is debt to finance an acquisition. And then Y. Y is guarantees of management equity plans. So what we need to highlight here is that those baskets together are limited to 140 million or 3.5% of consolidated total assets, not the general basket, clause Z, or X, the contribution debt basket, or indeed anything between P and A, so capital lease obligations basket. And that is some additional level of structural subordination risk that you would want to make a note of. Fox Legal Training students have access to an Excel spreadsheet where this kind of information can be kept. So you can refer back to it. You can just, I keep a lot of stuff on Post-it notes, and that's not very practical or well organized. So the Excel spreadsheet is a place where you can keep things much better organized than I am. Now, before we leave this analysis, I just quickly want to go and check those two defined terms because I said that I wanted to. So the first one was acquired debt. So I'm just going to go to debt means, and this is because I want to try to find things quickly. So acquired debt means debt of a person existing or assumed. Okay, so there's no amounts in here. I just wanted to double check. I didn't think there would be, but it's whenever you see a defined term, it's never a bad idea to follow the definition. And then we've got, we're looking for contribution debt. To click a couple of times, and that's here. And I'm happy to say that it is at 100% of net cash contributions. Now, sometimes that's 200, right? So that's why I really wanted to make a point of pulling this out and taking a look at it, because it would be obviously twice as much debt that was available there if it were set at 200. So I'm gonna stop my share. That is my top tip for the day, how to analyze for structural subordination risk. You can replicate this analysis for any given deal. So I'll just walk through the steps one more time. Go to the capital structure chart, figure out what the proportion is between guarantors and non-guarantors. Step 2, if the non-guarantors represent more than 10 or 15% of the total assets or revenue or EBITDA of the group, move on to step 3. Step 3, go to the debt covenant and review for those 3 pieces of information: the clause number, the amount, and what it can be used for, like mini for, and whether it can be incurred by non-guarantors. And then finally, check whether there is a separate non-guarantor cap. If you went through that whole analysis and you did not find any restriction for any specific basket to guarantors, then look for that non-guarantor cap, which we looked at together. And of course, just best practice for any contract, don't forget to chase down those defined terms just in case they reflect something which could be additional capacity or some level of additional risk. I would like to say before I sign off that I've spoken to a couple of students this week, and we had really great conversations about the deals that they were looking at, and I was able to help them make sense of some of the disclosure, which can be very complicated and can sometimes seem contradictory or internally inconsistent depending on how you're looking at it. And I loved that. So if you are a Fox Legal Training student, or indeed if you just like talking about covenants and you would like to run through one of these deals with me, please do not hesitate to get in touch. My email address is sabrina@foxlegaltraining.com, and I would be delighted to hear from you. And one more quick plug before I sign off for what I am very much hoping will be a sunny bank holiday weekend. We do offer online training courses for market participants in the credit markets, which is relevant if you're investing in high yield bonds or leveraged loans or private credit. So if any of what I've just said resonates with you as being something that would be helpful to you, to your practice, whether you're a junior in a law firm and you're looking to brush up on some of this stuff, or you're a credit analyst, or if you're a portfolio manager and you've been doing it for a while, but you want to make sure you've got all the latest tips and tricks and tools and want to know where all the loopholes are and all that stuff, that is what we do. And our online training program is always on, it's on demand, and I do in-person sessions too. So if you would be interested in any of that, you can check out our website, which is foxlegaltraining.com, and there are lots of opportunities for free resources there as well. There's a blog I've been doing for a couple of years, and then if you go to the events section, there are exciting events coming up. We've got one next Tuesday on views of minority creditors with Celine Boutentodd from Pivotal Point. So there's going to be some really fun stuff coming up. Keep in touch with us. We'd love to hear from you. Enjoy the rest of your day and weekend, or whenever it is that you're watching this. And thank you so much for tuning in. I will see you next time.